Hello and welcome to this overview on the new Portuguese covered bond legislation. My name is Claudio Domingues, and at Millennium BCP I'm part responsible for the bank's medium to long-term funding execution. The new covered bond law is a result of the transposition of the covered bond directive into national legislation, which has been completed in 2022. More recently this year, CMVM, the Portuguese capital markets regulator, now replacing the Bank of Portugal in the covered bond regulation and supervision, published the new regimes regulation, which has revoked the one published under the old regime. The old Portuguese covered bond law, inspired in those of the most established markets back in 2006, was already known to be robust and rather conservative. For this reason, most of the requirements and basic principles prescribed by the covered bond directive had been in place in Portugal all along. Nonetheless, the transposition of the directive introduced three new enhancing features into the national law, over which we will talk in detail later, and which are the compulsory 180-day liquidity buffer, despite being something some Portuguese programs had already on bespoke and voluntary basis, the obligation for the covered bond pool auditor be a separate entity of the issuer's accounts auditor, and the introduction of non-discretionary procedures in covered bond maturity extensions. Now, one element not resulting from the covered bond directive, but which the legislator kept from the previous legal regime, concerns credit delinquency. Basically, Portuguese programs cannot keep in their covered pools credits more than 90 days past due, and credit substitution must ensure that such is continuously the case. Assets eligible for Portuguese covered pools are essentially those described and referenced in Article 6 of the directive. First and foremost, these are the assets outlined in Article 129 of the CRR. Legislation makes it explicitly clear that the use of the European covered bond premium label is reserved for programs whose assets are Article 129 compliant. So, we are essentially talking about exposures to or guaranteed by a set of group of public sector entities, residential and commercial mortgages, as well as loans secured by mortgages on ships. Other Article 129 eligible assets, like exposure to financial institutions such as deposits or eligible derivative contracts, are limited by minimum counterparty credit ratings and to an overall maximum exposure of no more than 15% of the outstanding covered bonds. Portuguese legislation allows commercial and residential mortgages to be part of the same covered pool, provided their relative proportion doesn't change substantially over time. In practice, however, all Portuguese mortgage covered bond programs, both those still under the old regime and those already updated to the new one, have contractualized intentions to include only loans backed by residential mortgages and only over properties located in Portugal. The maximum loan-to-value LTVs ratios are the well-known 80% for residential mortgages and 60% for commercial mortgages. A maximum LTV of 70% for commercial mortgages is allowed if the program has a minimum OC of 10%. One novelty in this new legal framework was the adoption of a soft approach to the LTV limit, whereby loans with higher LTVs are allowed in covered pools, yet only the portion of the loan up to the applicable maximum LTV is considered in coverage calculation. On property valuation, Portuguese legislation requires that, upon inclusion of a mortgage loan in the cover pool, the underlying property must have a valuation undertook by a qualified company with adequate experience and relevant expertise, and that the valuation amount cannot be greater than the property's market value. Here, CMVM abstained from regulating a matter thoroughly covered by both domestic and European-wide legislation, to which they preferred to make reference to. And indeed, alongside domestic legislation, we have the CRR itself in particular, but not limited to Articles 129 and 208, which require property values to be verified at least annually or at least every 3 years, depending on whether they are commercial or residential properties. They also regulate the possibility of valuation using indexation methodologies and the requirement of a physical valuation when indices suggest a significant drop in property value. These obligations go beyond the scope of mortgages included in the cover pool and are therefore totally embedded in Portuguese banks' internal regulations and processes. Nevertheless, The issuance of European cover bond premium means, as per Article 129, there is an obligation for the value of any property backing mortgages in the cover pool to be verified annually, which in any event is a practice widely followed in Portugal. Finally, like the cover bond directive, the new Portuguese cover bond law presents the possibility of cover bonds being backed by assets not entirely compliant with Article 129. These assets can either be credits to other public sector entities or need to otherwise consist of a claim whose value is always determinable, backed by a mortgage, charge, lien or guarantee over physical assets with established valuation methodologies and whose ownership is object of a public register. Moreover, the LTV ratio cannot be higher than 70%, while exposures to the public sector require a minimum over-collateralization of 10%. This all said, note that at this stage there is no program backed by assets other than CRR-compliant residential mortgages and exposures to the public sector. Accordingly, all cover bonds programs updated so far state they are to issue European cover bond premium only. Like the cover bond directive, the Portuguese cover bond law requires assets' principal value to be greater than that of cover bonds, the so-called nominal principal. Likewise, it allows for other principles of calculation provided they do not result in higher coverage than that obtained by the nominal principal. Additionally, programs issuing European cover bond premium are under the obligation to comply with Article 129, which means complying with the nominal over-collateralization of at least 5%. Finally, the Portuguese legislation does not contain provisions allowing the lower minimum OC of 2% in the terms suggested in Article 129. Cover bond program's liquidity risk is mitigated through both the possibility of cover bond maturity extension and a liquidity buffer covering at least the 180-day maximum cumulative net liquidity outflow. Cover bond programs can issue bonds with maturity extension date provided terms and conditions contain the non-discretionary assumptions for such maturity extension. The cover bond maturity is always determinable, and the inherent risk-sensitive information is adequately disclosed to investors. Yet, a cover bond maturity can only be extended upon failure to pay, effective or foreseeable, deemed as not curable within a period of no more than 10 business days, or upon withdrawal of the issuer's banking license by the competent authorities. The issuer needs to communicate and justify such extension to CMVM 10 days before its effective date, or otherwise as soon as possible. Subsequently, CMVM can oppose to such extension within 10 days, in which case the cover bonds become due and payable either from the date CMVM expresses its refusal or upon the scheduled maturity date, whichever soonest. On the liquidity buffer, and for the purpose of calculating the 180-day liquidity buffer, the cover pool principal outflow is deemed to occur on the extended maturity date, when there is one, of course. The liquidity buffer needs to be part of the cover pool and formed by those eligible liquid assets mentioned in the cover pool directive. Now, foreign exchange and interest rate risk can be covered through adequate derivative instruments which are allowed in the cover pool, subject to the conditions established in Article 11 of the cover bond directive, which Portuguese legislation transposed in its entirety. This includes them being solely for risk hedging purposes, being sized by the risk in question, not terminating upon insolvency of the issuer, and with counterparties with a minimum rating of credit quality 2 or subject to authorization credit quality 3. Portuguese legislation starts by requiring the bank's board to appoint a cover pool monitor. The dismissal of the cover pool monitor is only allowed by just cause and must be communicated to CMVM within 10 days of its occurrence. Legislation is also specific on the aspects requiring ongoing monitoring, which, by the way, it extends to the context of insolvency and resolution of the issuing bank, and who mirror those specified in Article 13 of the Cover Bond Directive. The law also requires the cover pool monitor to report immediately any anomaly and the issuer to provide all the information the cover pool monitor requests to perform his role. Lastly, the cover pool monitor needs to produce an annual auditing report issued with a reasonable assurance level of reliability. The cover pool monitor must be duly registered with CMVM, be independent from the credit institution, and otherwise be in no situation liable to affect its independence. As such, it must be separate from the entity that is, or has been over the previous 2 years, the bank's statutory accounts auditor, or otherwise not be closely linked to it. Must not be also closely linked to the issuing bank or to any of its qualified shareholders, and finally, must not be the cover pool monitor over a period of more than 10 consecutive years. Portuguese legislation also allows for an internal cover pool monitor in the terms and subject to the conditions described in the directive. Lastly, in case of a resolution or insolvency of the issuing bank, CMVM can appoint a special administrator to manage the cover pool program as a separate entity and in the best interest of cover pool holders, namely to ensure timely payment of amounts, credit servicing and recovery, liquidation of assets, and of course, the repayment of cover runs. Remuneration of this administrator is decided by CMVM and is to be paid out of proceeds of the cover pool, with legislation also establishing its reporting duties to CMVM. Well, yes, as detailed earlier, programs issuing European cover bonds premium must comply with Article 129, with no assets other than those listed in that article eligible for the cover pool, and this includes compliance with the terms established by Article 129. Lastly, all current Portuguese cover bond programs are backed by Article 129 eligible assets, and all programs must lawfully updated so far under the new legislation are for issuance of European cover bond premium only. You can find all this and more in the Portugal section of the ECBC European Cover Bond Fact Book, whose 2023 edition has been just published. Thank you for your time and for your interest.